All right, we're going to talk about liquidation of a partnership. And we're looking at Ace Company. This is a list of their balance sheet, their assets, and their liabilities at the point when they're going to liquidate. Now, we say it's if there's no capital deficiency, what that means is that all of the partners have credit balances in their capital accounts when the partnership is liquidated. So let's do an example of a liquidation, the journal entries that you would have when this is the case, when there's no capital deficiency. So the terms of the liquidation are, first, the partnership sells non-cash assets to Paulson's Palace for $75,000 in cash. Okay, so let's do the journal entry for that. So they're going to debit cash for $75,000. Now that means all of the non-cash assets have got to go. So since we're going to list our debits first, we've got to debit the accumulated depreciation to the equipment for $8,000, and then these other three accounts will be credited. So accounts receivable is credited for $15,000. Inventory credited for $18,000, and the equipment is credited for $35,000. So if you add your debits, they equal $83,000 minus your credits. You have a gain of $15,000, and we'll just call that gain on realization. It could also be called gain on sale of assets. Maybe I'll put that in here. Important thing is that you recognize some sort of a gain. Okay, now the second one, journal entry, is that we need to allocate this gain to the partners, this gain of $15,000. So the journal entry to do that is we're going to debit the gain on realization, or whatever the account title is that you use, of $15,000. And this gain is going to get distributed 3 to 2 to 1. And so you add these up, and they add up to 6. So 3/6 goes to Arnett, 2/6 goes to Carey, and 1/6 goes to Eaton. So Arnett Capital, 3/6 times 15,000 is 7,500. 2/6 times 15,000 is 5,000 to Carey, and the remainder, 2,500, goes to Eaton. Okay, now the third thing is the partnership pays its liabilities. So they have a note payable and accounts payable. So we're going to debit notes payable for $15,000 and debit accounts payable for $16,000, and cash is credited for $31,000. And then the last thing is that whatever cash is remaining is going to go to the partners on the basis of their capital balances. So let's do some T accounts to see what exactly are their capital balances at this point in time. So we've got our cash account, and the beginning balance was $5,000. So we've got that, and then I'm just going to debit $75,000 from journal entry number 1, and then credit $31,000 from journal entry whoops, 31. So that gives us an ending balance of 4,900. So that's what's got to be distributed. Now, our net capital, the beginning balance was 15,000, and then we credited it for 7,500. So that gives our net a capital balance of 22,500. Carry, the beginning capital was 17,800. We credited it 5,000 in journal entry number 2. So Carrie's ending capital is 22,800. Eaton's beginning capital was 1,200. We credited it for 2,500. So Eaton has quite a bit less, but it's still a positive number. So that's the ending balance. And so if you add these three up, they do equal cash. So that's going to be the distribution. So our net capital was 22,500. We're basically closing it out by debiting it. Eaton, or Carry, is 22,800. By debiting it, we're going to close that out. And Eaton's capital, 3,700. And then we're going to distribute all of our cash of 49,000. So after this journal entry is posted, every single one of these will go to zero, and the company, the partnership, is now liquidated. Okay, so in this case, we're going to have a capital deficiency. And this is going to be because the non-cash assets are going to be sold for 42,000. So this is the same problem as before, the same facts, except instead of selling them for 75,000, we sell them for 42,000. So we will debit cash for 42,000. We will debit accumulated depreciation on the equipment for 8,000. I mean, basically it's the same journal entry as over here, except instead of having a gain, we're going to have a loss. We're going to have a loss on realization, which we'll come back to and fill in just a minute. Okay, so then I'm going to credit my accounts receivable for the balance of 15,000. The inventory is credited for 18,000. Remember, this is the same as, this is just right off of our balance sheet. And then the equipment is credited for 35,000. So if you add up the credits and subtract the debits, you'll see that we have a loss of 18,000. Okay. Now, just like before, that $18,000 loss has got to be allocated to our partners according to their 3 to 2 to 1 ratio. So we are going to be debiting each one of the partners' capital accounts for the 18,000 times their ratio. So our net, the ratio is 3/6. Carry capital was 18,000 times 2/6. This is like a tongue twister, this sixth word. And Eaton capital is 18,000 loss times 1/6, or 3,000. And then we will credit that loss. So it gets allocated amongst the partners. Okay, so now, same journal entry as before, when they, as number 3 here, when they pay their liabilities, you're going to get rid of the notes payable, debit it by 15,000, debit accounts payable 16, and credit cash for 31,000. So what you'll see is after we post these journal entries, 3 of the two of the partners are going to have deficiencies. So cash account, we started with $5,000. We debited it for $42,000, and we credited cash for $31,000. So that's going to give us an ending cash balance of $16,000, and that's going to be distributed. Arnett's beginning capital was $15,000, and then we debited it for $9,000. So that gives Arnett an ending balance of $6,000. Carrie's beginning capital was $17,800. We debited it for $6,000. So that gives Carrie a credit balance of $11,800. Eaton's capital beginning was $1,200. We debited it for $3,000. So that gives Eaton a debit balance of $1,800. So this brings up two different possible scenarios. If Eaton has $1,800, he can contribute it to the partnership, and then he'll end up with a zero balance in his capital account, and we can close out Carrie and Arnett. But if Eaton doesn't have $1,800, then Arnett and Carrie are going to have to absorb it. So let's look at the first situation, assuming that Eaton pays $1,800 to the partnership, and do the journal entries to show what that would look like. Okay, so Eaton is going to contribute $1,800 of cash. So we would debit cash for $1,800 and credit Eaton capital for $1,800. And so after posting these two balances or amounts, so these were the balances here. So cash was $16. We're going to debit it for $18. So that gives us an ending balance of $17,800. Arnett's capital is still $6,000. Carrie's is still $11,800. Credit Eaton's capital for $18. So that gives us a zero balance. And now we can close these out. We're going to debit Arnett's capital for $6,000. That'll take that to zero. Carry capital for $11,800. Eaton capital is already zero, so we don't have to do anything with that. And credit the cash for $17,800. So after this journal entry, all of the accounts are brought to zero. Okay, let's say that the second scenario occurs and Eaton does not pay his deficiency. So what we will have to do is we've got to remove the deficiency from Eaton's capital, and Arnett and Carrie are going to split the $1,800 according to their ratio. So it was 3 to 2 to 1, but the income ratios of Arnett and Carrie are 3 to 2, which adds up to 5. So we're going to take the $1,800, and Arnett is 3 to 5, or 3/5, and Carrie is $1,800 times 2/5. So what happens is, even though it was 3 to 2 to 1, Eaton isn't part of this, so you cross that off, and it's 3 to 2, which adds up to 5, and so that's where you get the 3/5 and the 2/5. So that ends up being $1,080 to Arnett, $720 to Carrie, and Eaton Capital is now brought to a zero balance. And so after posting this entry, we post this, Arnett's Capital was 6,000 credit. You're going to debit for 1,080. So you're going to end up with 4920. Carrie's Capital was 6,000. Debit it for the 720. So the balance there is, actually it wasn't 6,000, it was 11,800. Minus 720 gives us an ending balance of 1180 credit. And then Eaton's Capital is reduced to zero. So the journal entry to distribute the 16,000 of cash is going to go to Arnett Capital of 4920 and Carrie Capital of 1180, and they literally are going to get checks written to them for this amount. This is how much cash they're going to get out of the partnership. So you've got your 16,000 of cash, and that's how it's going to be divided.